We have a slightly better day in the market with many companies, including the Mag 7 sitting in the green, and a bit of a mixed performance in the financials industry. We got Visa and MasterCard pretty much flat, with PayPal up nearly 2%. Now year to date, we do still see red right across the board, double-digit decreases for the Mag 7, but there are other industries that have performed well, and the financials is fairly mixed. We have Visa and MasterCard both up around 10 and 4% respectively, but American Express and PayPal down quite severe, and the company under the spotlight today, SoFi Technologies, whilst up over 4%, is still down around 21% year to date. However, having said that, over the last year, they are still up an incredible 68%, and at the moment sit in the mid to lower end of the 52-week range, with just one buy rating from Seeking Alpha, and trading currently with a forward P sitting around the 45 mark. Now today we want to cover two things. One, a bit of bad news that has affected this company, and the second one, which we'll start straight away, is understanding if it is still now a good high quality company with long-term growth, or perhaps one we should consider selling. First thing we will flag though is their latest quarter earnings, Q4 24. Revenue was up double digit 19%. We also got to see their financial services, their fastest growing stream, up 84% on a year on year, as well as both members and products growing at some very impressive rates, and both of those we will touch upon shortly. Speaking of earnings, over the last 4 quarters, they have outperformed every single one on analyst targets. That is a 100% track record, and they expect 3 of the next 4 quarters to show growth. In fact, the next 3 strong growth at that, double digit at a bare minimum. But one thing investors don't like to see is the fact that when we look at the forward P, they are trading at quite a high premium, 43 versus the sector which sits around 10-11. So if you're adding this company right now, you are in fact paying a 311% premium, something that continues no matter what valuation metric you look at, whether that's price to sales, price to book. The company does trade at quite a high premium. Now it doesn't mean it isn't investable, and in fact their growth is very strong, which is a good sign, something you would expect for a company that trades above the sector, sitting at an A+ with revenue year on year 28%, and forward looking over the next 12 months anticipated 22-23%, well above the sector in the mid-single digit, but it is a little bit lower from what we have seen from the company over the last 5 years at 47 and 28% respectively. We do quite like the fact that their EBITDA growth over the next year is expected to be at 42%, well above the sector at 11%, but again we do want to drill the point home that this company over the last 5 years has been growing on pretty much every metric at a faster rate. So one question to consider throughout the episode, whether we believe the growth story of the company is starting to slow down, and ultimately when we run it through our own valuation towards the end, we will incorporate a margin of safety just to consider this. Now profitability does come in at a D-. Nice to see gross margin 83%, well above the sector at 60%, above their own 5-year at 78%, so we do note efficiencies. And on top of that, bottom line at 19%, whilst lower than the sector at 23%, it is good to see that over the last 5 years, where they have been loss-making, negative 23%, one thing we will confirm again, 2024 was a very strong year, as it was their first year where they were profitable. However, we do have to point out that cash generated from operations for SoFi is negative 1 billion. The sector does sit a lot higher because it is positive 144 million, but over the last 5 years, whilst they have been burning through cash, it has been at a faster rate at nearly negative 4 billion. As we said, there are many areas of the company that's growing at a very rapid rate, one of them being their members, which actually in the latest quarter, they exceeded the 10 million barrier, sitting at 10.1 million, and this is a very good sign. Ultimately, with a company like SoFi, this is exactly what you want to see. However, 2 things to consider. Again, we've already pointed their sales, their top line revenue has started to decrease, and they expect it to be lower than 28% in 2025. Definitely a consideration there. And the other one being their shares outstanding. Now look, if a company outperforms the S&P, you probably wouldn't care, but if they continue to dilute your position as a shareholder at a very rapid rate, this is something we would say to incorporate in your overall investment thesis. But it is a company that institutions love. With 38% ownership, we noticed 771 million worth of selling over the last year, but twice as much buying at 1.4 billion. And we also noticed the same in the most recent quarter. Institutions clearly very bullish. They have been buying more shares of SoFi than they have in fact been selling. And looking at what the insiders are doing with their 2.6% ownership, again we do notice quite a significant number of selling, 500 354 million, with a very small amount of buyers in comparison at 1.1 million. Although Q2 we get no movement, bearing in mind we have just entered into it, but Q1 we did get some selling at 1.31 million. Now we'll show you for full transparency, but do bear in mind we don't see this as a bearish signal. They sell for many reasons, personal and financial, and we in fact note the most recent sell was on the 20th of March, so about a couple of weeks, with the chief technical officer selling around 68,000 shares, netting them $900,000. Again, information is there if you want to incorporate it, but not something we would typically use. Now, SoFi ultimately see themselves as a one-stop shop for financial services, which also incorporates the lending element. We have personal, student loans, as well as home, and this is something to consider when we talk about the penetration by Robinhood later on in the episode, but at the moment, their numbers are very strong. If we solely look at the new members edition, in terms of compounded annual growth just over the last 5 years, it has been growing 53% year on year, with the most recent year, as discussed earlier, sitting at 34%, but that is also reflective in their new product additions, 55% growth over the last 5, with the most recent year being a 32% increase. However, what you will have spotted is over the last few years, the growth has been slowing down, so it's not just in their sales, but also in the number of members that have been added, and likewise in terms of the product additions. And we can also see double-digit growth across many different products, whether that's in relation to money, whether that's in relation to personal loans, but ultimately their growth is very strong, and the one key consideration is how much do we envision this to continue over the longer term. And again, that is highlighted in terms of the technological platform accounts, just in the most recent year up 15%. And another thing they are trying to do is move more towards the financial services as opposed to tech platform, and they say this is ultimately because it is more fee-based and capital-light source, which is something all shareholders would prefer to see, and that is noted when we look over the last few years. In fact, the portion of their top line revenue has been increasing in terms of financial services, going from 25% in 2021 to now sitting at 47%, and we do expect this to increase in terms of the mix moving forwards. Again, historical revenue is looking very strong, the most recent year up 26%, but we do notice a bit of a slowdown over the last few years. EBITDA margin looking very strong, sitting at 26% in 2024, and as we just highlighted earlier, 2024 was their first full year of profitability, something we do expect now to continue moving forwards. One thing that maybe does go under the radar is how strong this company is in terms of their numbers. They revised their guidance twice in 2024, absolutely smashing it, where in fact we can see their original guidance towards the beginning of the year was for top line revenue at around 2.3 to 2.4 billion. Now it came in at 2.6 billion, which was a 26% growth rate, and they'd envisioned at the beginning of the year 14 to 16%. They then revised it again in the year 22 to 23, and as we noted, very impressive reported results, and that is also reflected on the other metrics as well, including the bottom line net income as well as the earnings per share. So perhaps when you do look at the full year of 2025 guidance and Q1, you could argue perhaps that we do expect a little bit better, just reflective of how they have performed in 2024 and over the last few quarters, as we did highlight, with a mention here also of membership growth, which they do anticipate to be at least an increase of 28% from 2024. Now, Robinhood had an event on March the 26th where it was the Lost City of Gold, that is what they called it, and they essentially unveiled several new features aimed at enhancing their financial services. The first one, as you can see, they did call it Robinhood Strategies, which is an actively managed robo-advisory service offering personalized investment portfolios. Now, they've priced this at an annual fee of 0.25% of assets with a cap of $250 for Robinhood Gold subscribers, and this service includes portfolios comprising individual stocks and ETFs. They then unveiled Robinhood Banking, essentially a banking platform for Gold members, providing checking and saving accounts with benefits such as a 4% annual percentage yield on savings up to $2.5 million in FDIC insurance, and unique services like physical cash delivery to users' doorsteps. And we also got to see Robinhood Cortex, an AI-powered investment tool designed to assist investors with real-time market analysis and investment insights. Now, the company itself is actually up around 16% year-to-date, when we just saw SoFi was down around 20%, and these new initiatives mark Robinhood's expansion into wealth management and banking, positioning it as a more comprehensive financial service provider, and these new offerings introduce direct competition in areas where SoFi has been active, such as the online banking, the investment advisory services, which SoFi has previously attracted customers from the traditional banks, the fintech platforms, including Robinhood, and therefore the introduction of these banking and advisory services could ultimately intensify the competition and influencing SoFi's customer acquisition and retention strategies. Now, what we are finding is that investors are starting to monitor how SoFi are going to respond to these competitive landscapes, which could in turn affect SoFi's stock performance. But as we have noted, at least today, the stock is up around 3%, yet over the last 30 days, down around 17%. Now, we do also have a note, Robinhood is also sitting around the midpoint of the 52-week range. It does trade at a lower valuation, around 29 to 30, with a buy rating from Wall Street and a strong buy from Quant, although we can see the hold from Seeking Alpha. And they have a 75% track record, 3 out of the last 4 beats, and also similar, anticipating 3 of the next 4 quarters to show strong growth to the earnings per share. No surprise though, it does get a fairly low valuation grade, still trading at a premium to the overall sector around 156%, but also showing growth 58% to their top line year on year, 30% expected over the next 12 months. Again, sector is in the low mid-single digits, but unlike SoFi, their growth now is starting to increase above their historicals of 52 and 16% respectively. And in terms of profitability, they do look a little better. Gross margin 91%, above the sector at 60 and above their own 5-year of 76. Bottom line 48%, again above the sector at 23, and when we look over the last 5 years, they were loss-making, negative 79%, but again they are also burning through cash, negative 157 million just over the last 12 months, which is in fact more than what we saw over the last 5 years at negative 29 million. So what this means for the long term is something investors will need to consider. Remember, we have SoFi Technologies on one hand, the fintech company which provides online banking, lending, investing and financial advisory services, which includes, as we said, student loan refinancing, personal loans, credit cards and a high yield checking and saving accounts, and also operating a bank through SoFi Bank and offering investment services via SoFi Interest. But then you have Robinhood on the other hand, as we said, with some of their new strategies, some of their new offerings, the fintech platform that offers commission-free stock options in crypto trading, along with cash management and retirement accounts. And as we've just said, they have also expanded into banking, wealth management, and AI-driven investment tools to compete with traditional financial institutions. So let us know what you think below, but before we just jump into SoFi and the valuation of where we see this company, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone on the market over the last few days. And you'll also be able to grab a fresh copy from today, running through 35 stocks that are severely undervalued in the month of April. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can grab a copy of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. And just in case you did miss this Monday's copy, you can go in there now and grab this free spreadsheet running through all dividend kings, lots of information, undervaluation, overvaluation, as well as other useful points. Now we get our intrinsic price of SoFi at just under $16, derived from the DCF model, where we have the free cash flow year on year, growth rate moving forwards of 10%, although you can see a low, medium, and high 8, 10, 12. Numbers are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for SoFi or any others. But with a 10% growth rate, 8% discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and we get to just under $16, indicating 35% upside. And we'll show you for full transparency, for those that believe that is high, at 8%, intrinsically $14, 18% upside, and for those that believe it should be higher, 12%, $18, indicating 53%. Now, as typical on the channel, we take through the medium rate, where we're not just done there because we always like to add a margin of safety. We use 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that today, a buy at $14.30, and then we keep going till it's near the current trading price. And effectively, what we're saying in today's episode, around the $12 mark, we see a 25% MOS, with Wall Street themselves seeing $14.31 over the next year, translating to 19% upside. As always though, give us your thoughts. Is now looking like a great time to buy? Do you think this is a hold, or in fact, with the Robinhood news, a potential sell? We'll also highlight here, if you were to use the lower rate of 8%, that you would still get a margin of safety. And in fact, as you can see, at 10%, a buy at $12.55, at 15, pretty much around that. So if you believe the lower rate, a 15% MOS, and Wall Street's price target untouched at 19%. The other exercise that we do have here is in relation for those that believe SoFi over the shorter or medium term can in fact replicate PayPal and become as big as them. Right now, if they are able to do that, SoFi's price would be around $60, indicating 458% upside, but again, just a fun activity to do. As always though, let us know your thoughts. Is SoFi right now a buy, hold or sell? And don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us on Patreon where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.